the world of real estate, it can often feel like just a maze of numbers, right?
Absolutely.
But behind every stat, there's a story. Demand, supply, people making big decisions.
Mm-hmm. Human behavior, exactly.
And today we're diving into something really fresh. We've got the June 2025 data straight from the Tucson Association of Realtors.
Hot off the presses.
Yeah. So our mission for you, unpack these numbers, find the trends that matter, help you get what's really happening on the ground there.
Sort of cut through the noise.
Exactly. Your shortcut to being, well, really informed about this market right now. Okay, let's dig in.
Let's do it.
All right, big picture first. June 2025. Let's talk price. The median sale price, that's the exact middle, landed at $365,000.
Okay.
And that's remarkably stable, only down like 0.1% from last year, almost flat.
Wow. Yeah. Very steady there.
But compare that to total sales. We saw 1,204 sales. That's actually down a bit, 1.8% from last year. So stable price, fewer sales.
Right.
What's that combination telling us?
Well, it's fascinating, isn't it? It's this delicate balance.
Yeah.
It could be a quiet signal, you know? Even though the median looks stable, maybe the mix of home selling is changing underneath. It might mask a shift where perhaps higher-end sales are propping up the average, even as overall activity slows.
Yeah.
Sometimes you see that just before a market really pivots.
That's a great point. And speaking of the overall picture, total sales volume, the dollar amount hit over $539 million.
Okay.
That's actually up slightly, 0.3%. And the average sale price, which is different from the median.
Right. Pulled up by those higher sales potentially.
Exactly. It rose to $447,729. That's up 2.1% year over year. And the average price per square foot also nudged up a tiny bit, $231, up 0.9%. What else should we be seeing in these broad strokes?
Well, connecting those dots,
Yeah.
it really does suggest that while maybe fewer homes are changing hands overall.
Right, the 1.8% drop.
Yeah, the ones that are selling might be, skewing a bit higher up the price ladder. And that explains why the average price ticks up, even when the median holds steady and the total number of sales dips. It paints a picture of a pretty nuanced market, not just one single trend.
Okay, so we have the overall pulse. But let's zoom in. This is where it gets really interesting, I think.
Buyer behavior.
Yes. What are buyers actually doing? Are they still in that frenzy mode, or are they, taking their time, negotiating more?
The power dynamic.
Totally. And the numbers seem to show a shift. Median days on market dawn for June was 33 days.
33.
Which is a notable increase, right? Up 12 days compared to last year.
That's a significant slowdown, yeah. Almost 2 extra weeks.
And then how much are homes selling for compared to asking? The average was negative 1.89% under asking.
So still getting a discount on average.
Still getting a discount, and that figure itself is down slightly from last year, meaning the trend of selling below list continues. Does this just scream buyer's market now, or is it more complicated?
Well, it's definitely a clear signal. You can't ignore it.
Right.
More days on market, consistently selling under asking. It really signals we're moving away from that intense seller's market we saw.
Okay.
Towards something more balanced.
Right.
Maybe even, slightly favoring buyers in some situations. But it raises that key question.
Where?
Exactly. Where is demand still strong, and where are sellers really feeling the pressure to concede more?
Because it's definitely not uniform, is it? Let's break down the price ranges. This reveals some surprising stuff.
Okay.
The busiest segment, still the $300,000 to $399,099 range. 379 sales there.
That's usually the sweet spot.
It is, though sales in that specific bracket were actually down 6.2% year over year, so even the busiest spot is slowing a bit.
Interesting.
But here's where it gets weird. Look at the $800,000 to $999,999 range.
Okay, higher end.
Sales were up significantly, 20.6%.
Wow, okay.
And get this. The median days on market in that range actually decreased by 3 days. They're selling faster. What's going on there?
That is fascinating.
Yeah.
It suggests that even as the overall market cools, certain pockets, especially in that sort of upper middle luxury tier, are bucking the trend. It challenges that idea that all expensive homes just sit there. Buyers in that $800K to just under $1 million range, they're still moving, and moving decisively, it seems.
Absolutely. And it gets even more striking. The next bracket up, $1 million to $1.19 million.
Okay.
Biggest drop, in days on market plummeted by 15 days, down to just 16 days on market. Super fast.
15 days, that's quick.
And it's a big but these homes also closed the furthest under asking price on average, negative 4.5%.
Okay. So fast sales, but they're negotiating hard.
Exactly. So they move quickly, but sellers are giving bigger discounts to make it happen.
Precisely. It implies, there's strong underlying desire for those specific properties. They get snapped up.
Right.
But even at that price point, buyers are price sensitive. Sellers are willing to deal to close the sale fast. Speed shows demand. The discount shows negotiation power.
Okay, now let's flip to the other end. Homes under, say, $200,000. The $199,999 range. Average days on market was 44 days.
44.
That's up a massive 30 days from last year. A whole extra month.
Oof. Yeah, that's a big change.
And they closed 5.24% under asking. For a seller, 44 days, watching that clock tick.
It's tough.
And then taking a 5% haircut on price, that's gotta hurt.
It absolutely does. In this contrast, it really highlights where the market pressures are building.
Yeah.
The more affordable segments, longer selling times, bigger discounts. It suggests less aggressive bidding, maybe more cautious buyers down there.
Makes sense. Probably feeling interest rates more acutely, too.
Very likely. It's a clear sign that the lower end is much more sensitive to those broader economic pressures.
Okay, speaking of market pressure,
Yeah.
let's look forward a bit. New listings, pending sales, what's the pipeline look
It's
like?
good indicators, yeah.
New listings in June were 7,703, just a slight dip, 1.4% from last year, so sellers are still listing.
Pretty steady supply coming on,
But new pendings homes going under contract, that key demand indicator.
right? Tells you about buyer activity now.
That totaled 1,184, down 34 from the previous year. So slightly fewer deals being struck.
Okay, a slight cooling in immediate demand.
And total active listings stood at 4,816.
So inventory is building a little.
Which leads to the overall months of supply, calculated out to 4.0 months.
4 months, okay.
What does that 4 months tell us, just broadly?
Generally, textbooks might say 4 to 6 months is a balanced market. So
Yeah.
4.0 leans towards balance, but maybe still slightly favoring sellers overall.
Slowly.
And this is crucial, just the overall number.
Right. We saw how different price ranges are.
Exactly. That supply figure varies wildly. For example, you look at the $200,000, $299,999 range, only 3.12 months of supply. Still pretty tight. Things are getting absorbed quickly there.
Okay.
But then you jump to properties over $1.4 million. You're looking at over 10 months of supply.
10 months. Wow.
Yeah, a significant amount of inventory relative to how fast they're selling.
Yeah.
So that idea of balance really depends on where you're looking.
That makes perfect sense. And it's not just price, right? The type of home matters hugely, too. We're seeing some really surprising swings here.
Definitely. Property types are showing divergence.
Single-family homes, they're still the main player, obviously. 1,006 sales, that was actually up 1.3%.
Okay. Slight increase there.
Price per square foot up slightly to $236. Median DOM was 32 days, so up 10 days following the overall trend.
Pretty much in line with the broader market.
But here's the curveball. Manufactured homes.
Ah, yes, this was striking.
Sales surged, up an astounding 35.3%.
Huge jump.
Volume up 40%. Median price $245,000. They spent 36 days on market, which is longer than last year, of 29 days. But that sales volume.
It brings up that question again, why this boom in manufactured homes specifically?
Yeah.
Remember we talked about the shift towards buyers having a bit more leverage. This surge feels like a counter-narrative within that. It probably reflects those affordability pressures really pushing buyers towards, well, the most attainable options.
That makes a lot of sense. People getting priced out elsewhere, maybe.
Could be a big part of it. Now compare that to townhouses.
Oh, yeah. Completely different story. Sales down 35.7%.
Ouch.
Volume plummeted 38.6%. And their median DOM also jumped way up by 26 days to 39 days total.
Big drop off there.
And mobile homes, they had the biggest average discount under asking, MNIC of 6.5%. And the largest increase in days on market, up 43 days to 54 days total.
Wow, nearly 2 months on market on average.
So why this huge split? Manufactured booming, townhouses and mobile homes struggling more?
It really highlights these diverging paths within the market. Crucial for you to grasp.
Yeah.
Could be inventory levels, maybe financing options are different, or just buyer preferences shifting dramatically. Maybe the quality or location of available townhouses isn't hitting the mark right now.
MVP?
But the market is clearly segmenting itself. A lot seems driven by what buyers can actually afford or maybe what they perceive as value right now.
Okay, let's zoom out geographically. Tucson isn't just one market. Different areas have their own vibe.
Always true in real estate. Location, location.
The Northwest region, still powerhouse. Highest sales, 206. Strong increases too, sales up 10.2%, volume up 13.4%.
Northwest continues to be very robust, yeah.
Conversely, the Central region, still high volume, 151 sales.
Okay.
But it saw decreases, sales down 3.8%, volume down 6.0%. So even within the city, different experiences.
Absolutely. Central seems to be cooling off a bit compared to the Northwest. It just reminds you, those broad stats we started with, they don't tell the whole story for every single neighborhood.
Sure. And then you get these really extreme examples in the smaller outlying areas.
The micro markets.
Yeah. SEC Nogales East, sales jumped 150%, volume up 174.6%.
Sounds amazing, but
But right, it's from a tiny base, only 5 sales total. Still interesting that homes there closed the furthest under asking, negative 14.2%. Big discount.
small sample size, big percentage swings, and big negotiations, apparently.
Then SEC Rio Rico West. Also dramatic percentages. Sales up 250%, volume up 228.5%, again from only 7 sales.
Okay.
But surprisingly, they had a positive change in the percentage over asking, plus 6.0%, selling above list price on average.
That is surprising given the overall trend, but again, with only 7 sales.
Right?
1 or 2 properties that were highly desirable, maybe got multiple offers, could easily skew that average for a small area. It doesn't necessarily mean the whole area suddenly became a hot seller's market, more likely an anomaly.
Good point. Maricopa also showed a big positive swing over asking, plus 8.5%, but from just 4 sales.
Game principle, small numbers.
And SCC Elgin stands out too, highest median sale price, $905,000 from just 3 sales.
These micro markets are fascinating but tricky. Those huge percentage changes often tell you more about limited activity than a major underlying trend.
Okay, final piece of the puzzle. Size. Does the square footage matter in this market?
It seems to, yeah.
Most popular size, 1,500 to 1,999 square feet, accounted for 386 sales. Kind of that mid-range size.
Makes sense. Often hits a sweet spot for families or move-up buyers.
At the extremes, though, homes under 999 square feet, tiny homes.
Right.
Sales decreased 21.5%, volume down 23.7%.
So less demand for the smallest homes right now.
Seems like it. Maybe reflects those affordability issues we talked about, or just shifting preferences away from very small spaces.
Could be. The market for those smaller footprints definitely appears softer.
But here's the kicker. The biggest homes, 5,000 plus square feet mansions, basically.
Okay, the ultra-luxury end.
Only 4 sales. Tiny number. But the median price, $1.9 million.
Wow.
And get this, median days on market, 4 days.
Cool.
4 days, that's down 53 days from last year. A ridiculous drop.
That's practically instantaneous in real estate terms.
I know. And completely against the overall market trend, they sold for 2.7% over asking price on average. A huge positive swing of 11.3% compared to last year. What is happening there?
Okay, that's not just about luxury. That signals something else.
Like what?
Extreme scarcity for the truly unique, top-of-the-market properties. When one of those rare, massive, probably very special homes hits the market, it's acting almost like a collectible. It defies the general market cooldown because it's so rare.
So it's not just price, it's the rarity.
I think so. That dramatic drop in DOM, selling over asking. It suggests that for those specific 4 properties, demand was incredibly high and concentrated. They're outliers, but fascinating ones. It shows that even in a softening market, truly exceptional properties can command intense competition.
Wow. Okay, so wrapping this all up, what does this deep dive into June 2025 tell you, the listener?
Well,
It shows a Tucson market really in transition, right? Overall, prices look stable, holding steady.
on the surface.
But underneath, sales are a bit slower, homes are taking longer to sell, and getting that asking price is tougher for sellers, on average.
Definitely more negotiation happening.
But the real story, as we saw, is in those details. Huge variations depending on the price point you're in, the type of home, the specific neighborhood, even the square footage.
Exactly. Pockets of surprising heat, like certain luxury segments or manufactured homes, alongside areas that are clearly cooling faster.
It's definitely not a one-size-fits-all market.
Not at all. Which leads us to a final thought for you to chew on.
Yeah.
What do this shifting dynamic, this segmentation, mean for the future? Particularly for new construction and development in Tucson.
Good question.
Will builders pivot? Will they try to build more of those manufactured homes or target that $800K $1 sweet spot we saw? Or will the market keep diversifying in ways we haven't even seen yet, driven by, changing buyer needs and whatever the economy throws at us next?
Lots to think about there. Builders definitely have some interesting data to consider.
For sure. Something for you to mull over.
Absolutely. Well, that's all the time we have for this deep dive. We really hope you feel much more informed now, ready to navigate this very interesting Tucson real estate landscape.
Hope it was helpful.